We're analyzing Zoom Video Communications, stock ticker ZM. Zoom was a high-flying stock during the pandemic. Now that its price is down, is Zoom on sale? We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Zoom. Then we're giving a final rating to the business. Also, Michael Burry recently bought into the company. 6.9% of his US-based portfolio that shows on his 13F is invested in Zoom right now. Before we get into these valuable metrics, let's understand Zoom's stock performance. Right now, Zoom trades for $66.62 per share. Year to date, their stock price is almost exactly flat. In the last 3 years, Zoom's stock price has fallen by 74%. The company's down nearly 90% from their all-time highs in October of 2020. Zoom was listed publicly just 4 years ago. In that time, even with the company's huge declines, their stock is up 3%. Zoom's almost cut in half from its 52-week high. The company trades just $6 above their 52-week low. 5.5% of their shares are sold short. Zoom is still a big business. They have a $14.3 billion market cap. But the burning question is, why should we be paying close attention to Zoom? Zoom provides a communications platform that connects people through video, voice, chat, and content sharing. The company's cloud-native platform enables face-to-face video and connects users across various devices and locations in a single meeting. Zoom, which was founded in 2011 and is headquartered in San Jose, California, serves companies of all sizes from all industries across the globe. Now that we have that background, let's get into the numbers. Starting with metric number 1, for Zoom, we want their average return on capital since going public to be above 14%. A typical business earns about 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Zoom's returns on capital spiked in their fiscal 2021 and 2022. These covered calendar years 2020 and 2021. Since then, due in part to reinvestment in the business, their returns have fallen. Zoom earned about 4% returns in their most recent fiscal year. Averaged out, Zoom earns about 8.7% returns on capital in a given year over this time. While that's slightly above an average business, that's below the benchmark we'd be looking for, meaning this is an X on metric number 1 for Zoom. Metric number 2, we're looking for growth in the business. We want to see 5-year revenue, net income, and free cash flow growth. This metric's all or nothing. All 3 need to be up for this to be a check. We'll also be including their numbers until today. Since going public, Zoom's grown their revenues by 13 times. That's huge growth as Zoom became a necessity for many businesses during the pandemic. However, the company's earnings are actually down over this time. They've only earned $5.5 million of net income in their last 12 months. That's actually below where the business was at in 2019. Meanwhile, Zoom's free cash flows are up huge. Since calendar 2020, they produced more than $1 billion of free cash flow in each year. This big growth led by their revenues and free cash flows is really what we want to see, but because their net incomes are down, this is an X on metric number 2. Metric number 3, we're looking at Zoom from the view of an individual shareholder. We want to see earnings per share growth since they've gone public. We learned in the last metric, Zoom's earnings have declined by 27%. Since going public, Zoom's also diluted shareholders by 19%. Because their earnings are down and they have this shareholder dilution, this is an X on metric number 3. Does Zoom have what it takes to turn it around in the second half of our analysis? Metric number 4, we want to see free cash flow per share growth since Zoom was a public business. With their free cash flows growing and them issuing new shares, these two will be at odds. Their huge free cash flow growth outpaces their shareholder dilution, meaning this is our first check of the day coming in on metric number 4. Recapping where we stand currently, we have 1 check and 3 X's for Zoom through 4 metrics. During economic downturns, it's overly levered businesses that are at the greatest risk of poor outcomes. In metric number 5, we want Zoom's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced summed up in the last 5 years. During this time, Zoom's had negative net debt in all 5 years, meaning after paying off their debt, they're left over with cash on their balance sheet. In all 5 of these years, Zoom's also produced positive free cash flows. That's in very sharp contrast to a lot of these other high flyers from the pandemic, many of which were cash flow negative. Metric number 5 looks great here for Zoom. This is another check. Right now, they have a $5.5 billion cash cushion. In the last 5 years, they produced $4.2 billion of free cash flow. The business both has a healthy balance sheet and they're cash flow generative. The big metric of them all, metric number 6, we want Zoom's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of two different ways we'll be using to estimate a fair value for Zoom. Right now, Zoom has a $14.3 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Zoom similar to it being a private company. In the last 5 years, we learned Zoom produced $4.2 billion of free cash flow, meaning in an average year, they produce about $837 million in free cash flow. When that's divided by their $14.3 billion enterprise value, we get about a 6% average free cash flow to enterprise value yield. On a current basis, Zoom produced $1.1 billion of free cash flow in their last 12 months. When that's divided by their $14.3 billion enterprise value, that gives us a 7.9% current free cash flow to enterprise value yield. Both of these are coming in above the yield of the 10-year treasury. They're also above the risk premium we'd be seeking, meaning Zoom's performed really well in the back half of our analysis. This is a check on metric number 6, but don't just run out and go buy the business. We want to come to a more concrete estimate of a fair value for Zoom. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Zoom, which takes us on to using a discounted cash flow model to come to an estimate of their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Zoom's free cash flows from their last 3 fiscal years, then using historical assumptions to grow these into the future. It's up to you to figure out if these assumptions will be accurate or not. Zoom's previous 3 years benefit significantly from the pandemic. You'd want to see how the business will be able to hang on to some of these gains and how they'll perform into the future. Assuming they grow these free cash flows at a rate of 5.8% annually for the next decade, then in the decade from there, if they grow them at 4% annually, if we add in the company's tangible book value, which gives an estimate of their net worth, if we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for in addition to his margin of safety requirements, an estimate of Zoom's fair value per share is around $61. There are key points to be aware of. This is an estimate of 3 abnormal, very good years for Zoom. You really need to understand whether this success will continue for Zoom or not. Their growth rate has slowed down considerably, coming off a much higher base. This makes sense as the business has grown and its vital role during the pandemic. Because of their insane growth, Zoom has had a low degree of business predictability. That could also be the case into the future, depending on if Zoom has durable competitive advantages. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Zoom, but we have to address something first. We've covered the numbers, but the qualitative aspects of the business are just as important. What are they? Looking at the factors supporting a potential long thesis, number 1, Zoom's low-touch, low-friction model helps drive strong margins. The company is already profitable on a GAAP basis, which is well ahead of other high-growth software peers. Number 2, Zoom offers a disruptive technology that's designed from the ground up as a video-first collaboration platform. Customer satisfaction is well above that for video conferencing peers. Number 3, Zoom's user base and revenue surged during the pandemic. It's expected most of these users will remain customers and drive continued growth in the coming years. We want to look at both sides. Let's cover the negative factors of Zoom as well. Number 1, Zoom completed its IPO in April 2019, so it has a limited operating history as a public company to scrutinize. Number 2, Cisco and Microsoft are prominent in the video conferencing market and can bundle an array of product solutions in response to a competitive threat from Zoom. Number 3, the biggest risk facing Zoom is executing across so many different aspects of growth simultaneously. For example, Zoom Phone is a more complex sale. The company's moving from smaller to larger enterprise customers. There you have it for a balanced perspective of some of the qualitative aspects of Zoom. Now it's time to give our final rating. In analyzing Zoom Video Communication, stock ticker ZM, we learned the company, although it has a short history of being publicly listed, has not surprisingly had huge revenue and free cash flow growth in the last few years. They earn lumpy returns on capital that are just slightly above a typical business averaged out. Their earnings are also down and they've diluted shareholders. That's not surprising for a high growth business. A big difference between Zoom and some of these other high-flying stocks is that Zoom has been cash flow positive in all 5 of their last years. They also have a cushy cash position on their balance sheet that can support their growth into the future. It's worth reiterating this analysis is not financial advice. Looking at their free cash flow to enterprise value yields, those both look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if you believe those assumptions from today's valuations and are looking for a 15% rate of return, an estimate of Zoom's fair value per share is around $61. Zoom traded at those levels as recently as May 2023. They were just slightly above that price when Michael Burry was buying into the business. Looking at all the factors of our analysis, Zoom looks like a strong candidate for further research. Remember, this is not a buy or sell recommendation of any security. It's not financial advice. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Zoom, and let me know what business you want me to look at next in the comments below. Thanks for learning about Zoom with me, and have a great day.